In 2007, three warnings went off before the crash: an inverted yield curve, a shadow lending market stuffed with unregulated debt, and a handful of institutions holding more risk than entire countries. 15 months later, $19 trillion in household wealth was gone. Today, the yield curve is behaving strangely again. The unregulated lending market, the one nobody watches, has grown to $2 trillion, and 7 companies now control a larger share of the stock market than at any point since 1929. This is not déjà vu, this is a pattern. And by the end of this video, you'll know exactly which parts of the 2008 playbook are already running again, and which ones aren't. In September 2025, 2 subprime auto lenders, Tricolor and First Brands, collapsed within weeks of each other. They weren't banks, they were private credit, the kind of lending that lives outside normal bank oversight. Investors who'd bought into that debt lost money fast and quietly. It barely made the evening news. But Jamie Dimon, the CEO of JP Morgan, put it bluntly: when you see one cockroach, there are probably more. A month later, bond investor Jeffrey Gundlach said flatly that the next financial crisis would come from private credit. There's a paper trail for this. By the end of this video, you'll understand exactly which 3 pre-2008 conditions are back, which ones are different, and how to tell the difference between market noise and an actual structural warning. Here's where we're going. First, the crack. What's happening right now in private credit and AI debt? Then, the root, how deregulation in the late 1990s and early 2000s built the machine that broke in 2008. Then, how that same machine works today, just wearing a different name. Then, where it's already cracking, and finally, what this actually means for your mortgage, your 401k, and your job. No hype, no prediction of a specific crash date, just the mechanism laid out so you can watch it yourself. Here's the crack right now in 2026. Private credit, lending done by investment firms instead of banks, has grown to somewhere between $2 and $3.5 trillion globally. It grew 5-fold since 2008, specifically because new regulations made it harder for banks to make risky loans. So that risk didn't disappear, it just moved to firms nobody regulates the same way. In May 2026, the Financial Stability Board, the world's top banking watchdog, issued a warning. This market has never been tested by a real downturn, and nobody has clean data on how deep the risk actually runs. But this isn't the first time regulators warned about hidden leverage. Here's where it started. In 1999, Congress repealed the Glass-Steagall Act, the Depression-era law that had kept commercial banks and investment banks separate for 66 years. A year later, the Commodity Futures Modernization Act made sure a new financial product, credit default swaps, would stay unregulated too. That mattered because banks were about to invent a way to package thousands of risky subprime mortgages into bonds called CDOs, collateralized debt obligations, and sell them as safe investments. Rating agencies stamped AAA ratings on debt built from loans given to people who, in some cases, couldn't prove they had a job. By 2007, the CDO market had swollen past $600 billion a year, and insurance giant AIG had sold so much protection against these bonds defaulting that when they did, the US government had to bail AIG out for over $180 billion just to stop the collapse from spreading. Here's what changed after that. Congress passed Dodd-Frank in 2010, tightening the leash on banks. Higher capital requirements, more oversight, less risky lending, but capital doesn't disappear when you regulate it, it migrates. Private equity firms and asset managers built new lending arms specifically to do what banks could no longer do cheaply. That's the mutation. The 2008 machine ran on banks holding too much risk in plain sight. The 2026 version runs on non-banks holding risk in the dark. Same fuel, different engine. Let's break down how this actually works. No jargon left untranslated. Start with the yield curve, because it's the indicator everyone name drops, but almost nobody explains. The Treasury yield curve just compares the interest rate on a 2-year government bond to a 10-year government bond. Normally, longer loans carry higher interest because more time means more uncertainty. When that flips, when the 2-year pays more than the 10-year, that's called an inversion, and it means investors expect the economy to weaken enough that the Federal Reserve will have to cut rates later. It's preceded every U.S. recession since the 1970s. In mid-2026, that curve inverted again. 10-year yields dropped below 2-year yields by roughly 18 basis points in July, before partially steepening back out in the weeks after. And that steepening is actually the more dangerous signal, historically. Recessions tend to start after the curve uninverts, not while it's still flipped. Now, here's the analogy that makes private credit make sense. Imagine you're a bank. You want to lend money to a risky mid-sized company, but new rules say you need to hold extra cash in reserve if you do, so instead, you don't lend directly. You invest in a fund that lends on your behalf. The fund isn't a bank, so it doesn't follow bank rules. It also doesn't have to tell the public much about what's actually inside its loan book. That's private credit in one sentence. Bank-style risk without bank-style transparency. Here's the step-by-step. Step 1. An asset manager raises money from pension funds, insurers, and increasingly regular retail investors. Step 2. That fund lends directly to companies too risky or too small for a traditional bank loan, charging high interest, often 9 to 11%. Step 3. The fund promises investors they can pull their money out periodically. These are called evergreen funds. Step 4. But the underlying loans are illiquid. You can't sell a private loan to a mid-sized manufacturer the way you sell a stock. That mismatch, liquid promises, illiquid assets, is exactly the mismatch that broke money market funds and mortgage bonds in 2008. Goldman Sachs estimates about 80% of private credit sits in long lockup vehicles that don't allow investors to withdraw on demand. That part is actually more stable than 2008's structure. The dangerous 20%, roughly $220 billion, sits in those evergreen retail funds that do promise regular redemptions. If enough investors ask for their money back at once and the underlying loans can't be sold fast enough, that's a bank run, just without a bank. Now layer on the second piece, concentration. The 10 largest companies in the S&P 500, Amazon, Alphabet, Nvidia, Meta, Microsoft, Tesla, and a few others, now make up about 40% of the entire index's value, well above the 27% peak of the dot-com bubble in 2000. Several of them are borrowing heavily to fund AI infrastructure. One, SpaceX, raised $25 billion in bonds shortly after an $86 billion stock listing. In 2008, the risk was concentrated in mortgage bonds nobody could value properly. In 2026, the risk is concentrated in 7 stocks and their debt-financed bet on AI demand materializing on schedule. Here's where the gap between the sales pitch and reality shows up. In 2007, when the first subprime cracks appeared, Federal Reserve Chair Ben Bernanke told Congress the problem seems likely to be contained. It was not contained. Within a year, Bear Stearns collapsed, then Lehman Brothers, then AIG needed a government rescue. In 2026, you can hear an almost identical reassurance. Oaktree Capital's Howard Marks said publicly there isn't a systemic issue with private credit, while, in the same reporting, acknowledging the sector's rapid 15-year growth could expose weaker lenders once conditions worsen. That's not a contradiction that makes him wrong. It's the exact same shape of statement regulators and executives made in 2007, real risk, described in soothing language, right up until it isn't soothing anymore. Who benefits from that soothing language? The asset managers collecting fees on $2 trillion of private credit, the 7 mega-cap companies whose stock prices depend on investors believing AI spending will pay off before the debt comes due, and, honestly, everyday investors who don't want to hear that their 401k is more concentrated in 7 stocks than at any point in nearly a century. Nobody's lying, but nobody's incentivized to say, "This looks a lot like 2007" out loud either. Remember that $2 trillion private credit figure from the top of this video? Here's exactly what that looks like for real people. If you're a retail investor who put money into an evergreen private credit fund promising quarterly liquidity, you're a part of that $220 billion slice that can't easily be sold if too many people ask for cash back at once. That's not a hypothetical fee. That's a redemption gate that can freeze your money for months. If most of your 401k sits in an S&P 500 index fund, and for most working Americans it does, you're more exposed to 7 companies than you probably realize. 40% of that index's value now sits in magnificent 7 stocks. If AI spending slows before the revenue catches up, that's not a diversified retirement account anymore. That's a concentrated bet you didn't choose to make. And if you're a small business owner who took a loan from a private credit fund instead of a bank, because the bank said no, you're paying 9 to 11% interest instead of a traditional bank rate, and your lender has every incentive to call that loan in fast if their own fund faces redemption pressure. 3 different situations, 1 shared root, risk that moved out of regulated banks and into places with far less oversight. Strip the press release and the ledger reads like this. 2008 wasn't caused by the housing market. It was caused by leverage hiding inside opaque products, rated safe by people paid to say so, right up until the moment it wasn't safe at all. That mechanism didn't get fixed after 2008. It got relocated, out of banks and into private credit funds and concentrated tech balance sheets that regulators are only now starting to measure. Not every warning sign from 2007 is back. The banking system itself is better capitalized than it was then. But the underlying pattern, leverage plus opacity plus confident reassurance, is not a coincidence, and it is not new. It's the same machine running on a different fuel. The question was never whether the exact same crisis will repeat. It never does. The question is whether you can recognize the shape of it before everyone else does. Now you can. If this is the first video you've landed on, this is what we do here. The story underneath the story. Subscribe to American Ledger Journal. Hit the bell so the next one finds you. And if this gave you something worth passing on, send it to someone who needs it.